going to be doing today? Good afternoon again to everyone. It's 16 minutes past 4. And what are we going to be doing today? We will be looking, we started partnership changes on Monday, and we went through the whole PowerPoint presentation to do with partnership changes. That's what we did. And we would have read through the lean and heart question. So what we are going to be doing this afternoon is that we are going to look at revaluation of assets, because all of this is coming up in the lean and heart question. And we have to know how to, we have to have some type of understanding of these things before we can actually move forward into other aspects of the question, right? Because one of the first thing the question asks us for is a revaluation account. I'm looking for my presentation. Okay, so let me share my screen with you. And we're going to talk about revaluation, and then I'm going to get you to do some work for me quickly, and I'm going to tell you something that I want you to do for me as well for our class on Friday. Yes, please, Friday. Right. So we know that in lean and heart, when you write it, and I hope by now everybody have, all of you have access to that question. You will know in lean and heart that they would have stated that on Hart's retirement, the assets were revalued. So land and building were revalued, and then they would have told you that stock costing $800. They agreed that that had no value, and debtors owing $1,100 were declared bankrupt. So those are things that we need to deal with. All right. So we are going to speak about revaluation in the context of the fact that whenever there is a sale of the business or a change occurring in the agreement of the business, the assets and liabilities are revalued. And we're going to talk about why that would happen, because Lynn and the question had asked what is the reason for the revaluation of the assets when the partnership agreement change or when there's a sale. So we're going to look at why that happens. So let's talk a little about it. Now the revaluation is undertaken so that you can derive the true worth of the business at the point of a sale or change in the partnership. So the reasons, so when you look at Lane and Hart, when they revalue their assets at that point in time, what is happening is that they are trying to find out what is the true worth of the business at the point in time that Lane retired, or if it was a business that was being sold, what is the true worth of the business at the point in time of the sale. So this is the reason why they're undertaking the revaluation of the net assets. Also, when you look at revaluation of assets, whenever a business revalue its assets and liabilities, they will either make a gain or what we would call a profit on the revaluation process, or they can make a loss on the revaluation process. So let's talk about when they're making gains and losses with respect to revaluation. Now the gains or losses at the point of the revaluation, you should record them in the partnership books using this account here called the revaluation account. So don't get mixed up, don't get confused. You are using an account called the revaluation account. And for those persons who would have just come from ACCT 100, and I know everybody in this class would have done ACCT 200. I'm talking 100. I know what I'm saying.
Just now.
No. I'm talking about last semester. done ACCT 100, those who would have done ACCT 100, you would have known that, and all of you would have done it, because as long as you're in the majors, you would have done ACCT 100. You would have known that you did a unit called capital reduction. And when you're doing capital reduction, you had to revalue the assets and liabilities were revalued, and you had to record those in the journal. So we are doing the same thing here, but with the partnership, we're recording it in the revaluation account. Okay, so we're recording it in the revaluation account. The revaluation account can increase or decrease the the revaluation process can increase or decrease the values of the net assets, which will cause the business to have gains or losses. Okay, so the revaluation can increase or decrease the value of the net assets, causing gains or losses. In other words, if you are valuing a car, because it is a vehicle, the value of that vehicle is going to go down, most likely, and not up. If you are valuing a property, there's a likelihood that the value of that property would increase based on what you would have done with it rather than decrease. So let's say you would have bought a property previously, and when you bought the property, it had a lot of bush on it, and the house was not in pretty good condition, and you would have bought that property at one price. So then when you get on the property, you do some nice landscaping, you put in your trees, you put in your lawn, you put in your nice stone in the driveway, make your driveway look nice. You do it fencing, you put on an automatic gate, all those things you do. And when it comes to the house, you put on some paint, you probably change some of the galvanized, change the ceiling, take out old cupboards, put in new ones. And the tiling on the floor was probably some old vinyl, and you took that up and put down either ceramic or porcelain. So when you're doing those things, it means that you're kind of making the house worth more. And when you come in the property, as a matter of fact, so when you bring in a valuer now, what you would have bought it for originally, the house may not, the property may no longer value that amount, because you would have made some changes that will cause it to increase. So this is why we're saying revaluation can increase or decrease the value of your net assets, which will be causing you to get gains or losses. And finally, the revaluation gains or losses affect the capital of the existing partner. So this is important to know. The revaluation gains, the gains or losses affect the capital of the existing partners, not the one that is coming in, the ones that were already there. So since we've spoken about that, let's look at some accounting entries. And we want you to take special note of these accounting entries with respect to the revaluation account. So here are the accounting entries for the revaluation of your net assets. The first one, and this goes back to double entry principle. Now, when we are looking at the revaluation, we do not draw the asset account or the liability account. Okay, we don't ask you for the asset account or the nor the liability account. We only ask you to produce the revaluation account. Now, in my demonstration, I will usually just do the revaluation account, but for clarity purposes, you may see me draw the asset account or the liability account so you can see the double entry. Now, if you want to draw the asset account or the liability account, in that case, so be it, because that will be your working. But in the whole scheme of things, the only account that we're looking to mark is the revaluation account. So the first entry here is when the asset value increases. So if the value of the asset is increasing, then you are going to debit the asset account and credit the revaluation account. So you should take note of these accounting entries, because we have lots of notes on the website and perhaps you may not get to print them, because if you get to print them, well, you have them there handy. But if you don't get to print them, you should write these things in your book so that you can see it there in your book and you don't have to always go looking for the soft copy to get the information. So when you increase the asset value, the debit asset account, credit revaluation. When you decrease the asset value, so when the asset value is decreasing, what do? We debit the revaluation account and credit the asset account. So when the asset is decreasing, you are going to debit revaluation, credit the asset. When it comes to liability, if the liability increases, you are going to debit the revaluation account and credit the liability account. So third thing, when the liability increases its value, you debit the revaluation account and credit the liability account. And finally, when a liability value is decreased, you would debit the liability account and credit the revaluation account. Now, I want you all to note that the debit and credit that is going into these accounts is not the figure that you're given on the paper, the new value of the asset or the liability. It is not the new value or of the asset or liability that is given to you that you put in the revaluation account. It is the difference between the new value and the old value of the asset or the liability. So it's the difference that you're calculating, that you're putting in the revaluation account. So you have your accounting entries. So this is what happens when you have gains or losses on revaluation. Excuse me. When you have a gain from revaluation, the gain from the revaluation of the net assets are transferred to the credit side of the existing partner's capital account in their existing profit sharing ratio. So the profit on revaluation, the gains from revaluation of the net assets are transferred to the credit side of the existing partner's capital account in their existing profit sharing ratio. That is important to know. The converse is also true. The losses, when there is a loss from the revaluation process of the net assets, that loss is transferred to the debit side of the existing partner's capital account in their existing profit sharing ratio. It has nothing to do with the new partner that is coming in. It only has to do with the two partners, who are 2 or 3 partners, how many there were that were there originally. Okay, so the gain is transferred to the credit side of the partner's capital account and their profit sharing ratio, and the loss is transferred to the debit side of the capital account in their profit sharing ratio. So you either will get a gain on revaluation or a loss on revaluation. Okay, so you either getting a gain on revaluation or a loss on revaluation, one or the other, and you're transferring it. Okay, any questions at this stage? No questions?
No, ma'am.
Okay, let's look at the example question. This example question is in your PowerPoint presentation, and I'm going through it for the benefit, especially of those persons who are doing this course for the very first time. And it's called Pig, Lamb, and Soul. So pay attention to this here. It says paid land and sold. This is their statement of financial position. They have buildings at cost, 80,000. The motor vehicles at cost less the cumulative depreciation, office fittings, and the same thing as motor vehicle. You have inventory. So your motor vehicle is 16,500, office fittings 1,800. Inventory is 6,100, accounts receivable 74 by 800. And these are the capital accounts for paid, lamb, and sold. Paid has a capital of $60,000, lamb $30,000, and sold $22,600. The question goes on to say the above partners have always shared profits and losses in the ratio. Paid is 4, lamb is 2, sold is 1. So 4 to 2 to 1. So 4 and 2 is 6, 1 is 7. So the whole is 7, which meaning paid is getting 4 out of 7. Lamb is getting 2 out of 7. And sold is getting 1 out of 7. Okay, that's the ratio. From January the 1st, the assets were to be revalued at the profit sharing ratios. From January 1st, the assets were to be revalued as the profit sharing ratios are to be altered soon. So these existing partners, they're not bringing in anybody new, nobody's leaving. They're just changing the agreement to change the profit sharing ratio. So because they're changing the agreement, and because they're making a change to the partnership, this is why they're revaluing the assets. So the following assets are to be revalued to the figures shown below. Buildings is now going to be $106,000, motor vehicles $13,000, and inventory $4,894, and office fittings $1,450. What they want you to do, the revaluation account and the statement of financial position. Now I have a question for you. How much does building change by? How much does building change by? Go again, Abiomi.
$26,000.
Okay, so $26,000. And if you have to do the revaluation account, how are you going to do that in the revaluation account? Why the accounting entry?
I would debit building and credit revaluation.
Why would you debit buildings and credit revaluation?
Because the asset value is
Because the asset value
increasing.
Is increasing, correct, is right. So Abiomi said he would debit buildings credit revaluation with the $26,000. What about motor vehicles? Somebody tell me about motor vehicles, not Abiomi and not the young lady that spoke. Remember, I'm presenting mode. I don't recognize all the voices, so you need to identify yourself when you speak. So motor vehicles, tell me about motor vehicles. Somebody quickly.
Ma'am, 3,500.
So motor vehicle is doing what by 3,500? This is Shante?
Yes, ma'am, is
Okay.
decreasing.
And what would you do with it when you're recording it?
Debit the revaluation account and credit the asset account.
To debit revaluation, credit the asset account. Another person, inventory.
1,206.
1,206 is a layer cost.
That's it.
Go, okay, tell me the accounting entry.
The same thing as motor vehicles.
Okay, say it as motor vehicles. Office fittings. Next person.
This is Alicia, and it increased by $350. So we would debit the revaluation account and credit the office.
Okay, very good. So those are the accounting entries. So you see the accounting entries here. Debit buildings credit revaluation for the $26,000. Debit revaluation credit motor vehicles for 35. Debit revaluation credit inventory for 1206. And debit revaluation credit office fittings for 350. So now let's look at balancing the account. Here, when you come to here, you see that build the credit side. Remember that your total debits must equal your total credits. So your credits are $26,000, but when you add your 3,500, the 1206, and the 350, you only get 50. So the three of these add together is 5,056. So your debit side is only 5,056. So what is the difference between the two sides? What is the difference?
20,944.
Pardon?
20,944.
20,944. This is the teacher telling us 20,944 is the difference. So we're seeing that you find the difference on the revaluation account to determine a gain or a loss. So that's what you're doing. You're finding the difference on the revaluation account to determine a gain or loss. So it is this here, this 20,000, we're not going to say whether it's a gain or losses yet, but this $20,944 must be shared with Pitt, Lamb, and Soul in their profit sharing ratio. So I want you to go ahead. I want you to share this 20,944, remembering their profit sharing ratio. So if you don't remember, let me rehearse it. Pitt is 4, Lamb is 2, Soul is 1. So Pitt is 4, Lamb is 2, Soul is 1. So you have Pitt 4, Lamb 2, Soul 1. So go ahead and tell me the share that Pitt will get, Lamb and Soul.
Pitt would get. Mommy ready now?
Yeah, I ready. Yeah, I ready.
All right. Well, I can give you Pitt, so I can give you lamb.
Mm-hmm.
Lamb would get 5,984.
5,984. And who gave me Pitt?
Rakim put it in the chat just now.
Or what Rakim put in the chat? Because I can't see chat right now. Tell me what it is that he put there.
11,968.
Right. Okay. Somebody else now give me Soul.
2992.
2992. Okay, 2992. So pay is on revaluation. This is pay 11,968, Lamb 5984, and Sold 2992. We are seeing here in this note that when the credit side of the revaluation account exceeds the debit side, the partners have a gain or profit on revaluation. In other words, what they're seeing here is when the credit side of the revaluation account is bigger than the debit side, there is a profit on revaluation. So this 2094 here is a profit because the credit side is bigger than the debit side. So then the opposite holds true, that if the debit side is bigger than the credit side, then there is a loss on revaluation, and those partners have to share that loss in their existing profit sharing ratio. So now in our account, we'll put here is, because it has to be transferred to their capital account. So you have Pitt, which is 11,968. You have Lamb 5,984, and Soul 2,992. Okay. So you do not write balance carried on the revaluation account. You don't put balance carried on, put 20,944. No, you have to find the share this 20,944 to the partners in their profit sharing ratio, and that is how it is done there. So the revaluation account is debited, and then when you go to their capital account, so you see it here, capital account is credited. Okay, so this is the capital account here being credited for them. So because it is a gain or a profit on the revaluation, when you add whatever profit they would have got when they revalue the asset, it is going to increase the value of their capital. So when they increase the value of their capital, then they have new capital balances. So PIT new capital balance is 71,968, LAM is 35,984, and SOL is 25,592. So these are the new capital balances for the three partners. So after you would have done all of that, you would have gone through the question. Now, the questions that you all are going to get are not going to be that simple, okay? So let me put it out front. Because this question just talks about revaluing and doing a revaluation account and a statement of financial position. The questions that you get are comprehensive questions that include revaluation, doing the income statement, doing goodwill, doing statement of financial position. So it's all encompassing. So, but we just break it in segments so you get an understanding of how to do each part, okay? So after you would have done this, then you can go to the statement of financial position. And this is how the statement of financial position looks. When you go to the statement of financial position, you record the new figures for the assets that they spoke of, the new figures, not the difference, you do not put 26,000 here. You do not go back to the income, you do not go back and put these old figures here. So you do not put back the 80,000, the 16,500, and the 1,800, and you do not put back this 61 here, because these were the figures before the revaluation. You have to look for the new figures that they give you for the revaluation, and those are the figures that you put in the statement of financial position. So now you said the building is $106,000, motor vehicle $13,000, office fittings $1,450, and inventory $4,894, and then all the other things remain the same. When it comes now to the when it comes to the capital now, because as we stated that the capital increased because there was a gain on revaluation, the new capital values are entered here as well. All right, so we have all of those things going on there. Any questions at this stage?
Ma'am, why we can't get questions like these? This
Because
one
then
looks so simple.
but then there's no analysis. Accounting calls for analysis. Because when you go into the real world, into a business, there's nothing simple about running a business. Running a business calls for thinking and analysis. All right, there's nothing simple. All right.
Understood.
You know you like simple, Chloe, but you're not going to get simple. So this is what I want you all to do for me now. Well, not now, but this is what I want you all to do for me. The question, Lynn and Hart. Increasing by 30%. Right. So Rakim give me his answers in the chat. The question, Lynn and Hart, I all have that question because there's some work that I'm giving you to do. Lynn and Hart. Now, what I want you to do for me quickly before our time is up, I want you to write a heading and call it old agreement and another heading. I call it new agreement. And I want you to write down all the things that fall under the old agreement and all the things that fall under the new agreement. So that is what I want you to do for me quickly in the next 4 minutes. You're going to write a heading, call it old agreement, and another heading, call it new agreement. And you're going to write down all the things that are part of the old agreement and then all of the things that are part of the new agreement. Because when you're doing partnership change and you have to account for the changes that are occurring, you have to know what happened under the old agreement and what is happening under the new. That's number one. Number two, I want you to do the revaluation account, and the revaluation account is including this information here. So I want you to do the revaluation account for me, and you are going to do the revaluation account and you are going to drop it in the box provided online. The box is under partnership changes, not the one under introduction, partnership introduction. There's a new box because we're into a new topic and it's under partnership changes. So you are going to do the revaluation account and you're going to drop it in the box for me before Friday. So that on Friday, we look at that, we're going to come and look at goodwill on Friday as well. All right, so all a new agreement, that's what you're doing for me now. Writing what is in the old agreement and what is in the new agreement. And you're going to tell me those things before we leave this evening. All right. And if you have questions, you can ask those questions as well. Okay, so no questions. Thank you.